Hello everyone, welcome to my channel. In this video we're going to look at the Japan carry trade. By the end of this video you'll know everything you've ever wanted to know about the Japan carry trade. Now the important thing to take away from this is that if the yen goes up in value or if the United States dollar goes down in value, that will negatively affect our stock markets. So if Japan raises its interest rates or the United States lowers its interest rates, which we're going to be doing shortly, it tends to hurt stock markets. And the Japan carry trade is not fully wound down yet, as we shall see. Over the years, the Japan yen has usually been in the 120s, 120 yen to the United States dollar. And lately, it's been edging up to 150. It's around 147 or so. So this major difference in exchange rates has a major effect on if you've ever wanted to go to Japan and want to go there cheaply, now's the time to do it because you get such a favorable exchange rate on the US dollar. You get so many more yen per US dollar. Carry trade blow-up haunts markets rattled by rapid unwind. Yen surge sowed havoc as traders dumped assets to repay loans. Brief global crash shows risk fanned by Japan's low rates. The death of the carry trade is being called a little bit prematurely, said Julian Howard. By now, last Monday's global market meltdown looks more like a brief tremor, a fleeting panic unleashed by a small policy shift from the Bank of Japan and resurgent fears of a U.S. recession. But the way it unfolded so rapidly and just as quickly faded out is exposing how vulnerable markets are to a strategy that hedge funds exploited to bankroll hundreds of billions of dollars of bets in virtually every corner of the world. The yen carry trade, as it's known, was a surefire recipe for easy profits. Just borrow in Japan, the world's last haven of rock-bottom interest rates, then plow it into Mexican bonds yielding over 10%, Nvidia's soaring shares, or even Bitcoin. When the yen kept falling, the loans became even cheaper to repay, and the payoffs turned that much bigger. Then, seemingly all at once, investors bailed out of the trade, in turn helping to fuel a furious rebound in the yen and swift exodus from equities and other currencies as traders dumped assets to meet margin calls. It roiled Japan's stock market, too, setting off the fiercest one-day sell-off since 1987 on concern the surge in the currency would hammer exporters. The yen carry trade remains the epicenter of everything in markets right now, said David Luntz, head of ETFs at Jones Trading. The pressure had been building up for weeks as markets in carry trade hotspots sputtered. The NASDAQ 100 index slid off record highs, and worries mounted that the Federal Reserve had kept monetary policy too tight for too long. Then came the spark, an interest rate hike in Japan. The Bank of Japan's benchmark is now a mere 0.25%, the lowest in the industrial world. But the increase at the end of the month was large enough to force investors to rethink their long-held belief that Japanese borrowing costs would always remain pinned near zero. Yen-funded carry trades have capitulated. Yen-funded returns have given up most of the year's gains. Even though markets have steadied, the episode is raising alarms about how much leverage had built up around Japan as its central bank kept pumping out cash despite the post-pandemic inflation surge. That's left anxious traders trying to gauge whether the bulk of the unwinding is over or whether it will continue rippling through markets in the weeks ahead. Coming up with an answer is tricky because there are no official estimates for how much money is tied up in carry trades. According to global data TS Lombard, there was some 1.1 trillion piled into the strategy, assuming all overseas borrowing in Japan since the end of 2022 was used to finance it, and domestic investors used leverage for their foreign purchases. The recent turn has likely tampered down the carry trade, at least temporarily, with traders anticipating more volatility in foreign exchange markets this year. The carry-to-risk ratio for yen-funded trades targeting 8 emerging market currencies fell to the lowest in about a year last week, suggesting the reward for the strategy has worsened, according to data compiled by Bloomberg. No trade lasts forever, and the facts have changed, said Jack McIntyre, a senior portfolio manager at Brandywine Global Investment Management. The Bank of Japan tightened and something broke, in this case, the carry trade. So the main question right now is the carry trade over? Has it been unwound? And it's estimated that about 60% of it has been unwound. So that leaves 40% to unwind when we lower interest rates, as we're sure to do in September. I think the Fed's going to lower it by 1/4 of a point. And I think part of the reason they're going to do 1/4 of a point instead of a 1/2 point is because the 1/2 point worsens the carry trade and is more destabilizing to the world economic system. And they want things to go down orderly. And so they will do 1/4 of a point, in my opinion. That's the way I roll. Thanks for listening.